Investment Committee. We are back in open session. And Brian, do we report out at this point the actions, if we took actions in closed session, or do that later?
No, you can do that now.
Okay. So
If I can, all you on the investment decision is just that you made a confidential decision on an investment. It remains confidential.
we need to disclose the asset class, or
No.
so in closed session, the CalSTRS Investment Committee took action to invest in a specific allocation of capital to a new investment opportunity for the fund. With that, we will go to the Chief Investment Officer's report, which is item 7. Chris. Oh, before I hand it off to you, Chris.
Yeah.
If there are members of the public that have comments on any of the items or would like to address the investment committee, I'd ask that you fill out one of the forms that are in the back of the meeting room on the table. And if you would submit that to Mr. Bartow, Brian Bartow, our general counsel, he will see that I get this, and we will recognize you at the appropriate time. Chris? Thank you.
I tried to modify my slides based on the comments you guys made at the offsite, so please give me feedback if this is too many pictures, not enough, too much motion. But I wanted to start appropriately at a very high level, and then I'm going to get into the detail. And I thought this was probably the best way to describe very high level. So first comments are going to be from 5 miles up, then I'm going to get down into the details. I don't.
Space Odyssey.
One of our students,
Space
one of our nice
Odyssey.
students in Stevens area gave that to me from NASA. So why are we dealing, what are we going through? What is the problem in the economy today? It is best described as 3D, the great deleveraging. And first, obviously, we had corporations and banks. The banks and the financials got the money from TARP in different ways, so it was very fast. And most companies really deleveraged themselves in 2009, and that's why the equity market took off so nicely in 2010 and the beginning of this year. But what we're dealing with now is consumers, and then lastly is going to be governments. Consumers, believe it or not, we are deleveraging. If you look at the amount of credit card receivables, they're going down just barely. So people are paying off their debt. If you look at the profits of Visa, MasterCard, First Data, their profits are up. People are using their cards, so they aren't just stopping, but they're trying to pay it down slowly. The problem is, as consumers, our biggest asset is usually our home, and we leverage that, and now we can't. So we can't deleverage until we get more income, and income comes from jobs. So consumers is going to be very slow. But the next one that we're feeling the pain and we'll spend time talking about is obviously at the government level. Not only the European governments, but obviously our own government, and even down to municipalities of states, even cities, because everybody borrowed more than they probably should have and leveraged too much in the 80s and the 90s and the 2000s. And now we have to go through this unwinding process. And I think I got this from McKinsey. I think they really put it best. McKinsey describes this as not an income statement recession, which most of them are. This is a balance sheet recession. So if you think about it, you've got to rebalance your assets and your liabilities. That is much harder to do, where an income statement recession is, I just need more cash flow. They say that a deleveraging or a balance sheet recession takes much longer, on average 3 years. So it's what we're going through now. It's not a recession technically, not negative GDP, but it is GDP growth below 2% or below 2.5%, very slow anemic growth. And we're certainly seeing that in Europe. I think I pointed out this morning in my email to you that with the ECB's comments where they lowered their rates for the first time in a long time, what was really more profound was the fact that they reiterated a GDP forecast that matches our Fed, where they're saying European GDP is going to be anemic at best for the next 2 years. So we're going to be in this for a prolonged period of time. Another quote that I'm borrowing from McKinsey is certain uncertainty. I thought that was well put, which is that our life is more dramatic. We've talked about that a little bit already. These are some of the different problems that exist out there that we've talked about before. But the bottom one I wanted to point out, which I thought was rather startling, we talk all the time about increased volatility. I have a couple of slides on that. But I went back and counted the days. And our portfolio is $150 billion, so it does move up and down a lot. But $1 billion is a big number. 35 of the last 65 trading days, so that's August, September, and October, our portfolio went up or down by $1 billion in a day. There were several days where we went up or down $3 billion in a day. That we have not seen that. The only other time period we saw that was in 08, 07. Before that, that didn't happen to us because our portfolio wasn't that big. It was uncommon for the market to go up or down 1%. But look at these slides. They show you. Now, this is the volatility index, the VIX index, a Bloomberg chart. Since June, July, you can see that's how it normally trades. And then look at the volatility with the U.S. downgrade in late July and then the enormous volatility. I was talking to Harry yesterday, and I wanted to try and find a mountain range, and I realized I can't. I mean, even the Grand Tetons aren't that spiky and that sharp. But you can see it. And now, to give you the perspective, here's the VIX index, that same index, all the way back to 2005. So you can see prior to 08, it traded basically in the high teens, maybe hit 30. 30 was like, you know, Danger Will Robinson. And then we had the 08-09, where all of a sudden it went up to 80 for the first time ever. But then it calmed down again. But you can see that this summer and this fall is back up in that 30s to 40s range, which is historically unheard of and represents the kind of volatility we're experiencing. So now a little bit closer to the detail. I had to use this because this is one of my favorite charts. I just love that picture. You're all going to be asking me for it. I know you are. How do I get that? So a little bit into detail. I know the teachers in the room will care about this. At Halloween on the 31st, the portfolio was $147.5 billion. Yeah. We had a good October. We were up $9.1 billion in October. We are still negative fiscal year to date, though. We're down about 3.2% as of Monday night on this fiscal year since June 30. So not as bad as some of the broad markets, look since June 30. Certainly not as bad as some of the European markets look. That only includes 1/4 of private equity and real estate. They lag, so we don't have what they've done recently. But we are still digging ourselves out of a hole. And as we've said before, the key is we're underweight global stocks on purpose, and we're maintaining about 1% to 2% of the portfolio in liquidity and short-term cash so that we're ready to buy if opportunities present, but we're also being defensive in that strategy. So it is all about Europe at this point in time. Those are the three countries that need to borrow money. Greece, Italy, and Spain. And I'll show you the interest rates in a second. These are the two countries that have the money and are controlling who is going to loan it to them. That's a picture up at the top of Sarkozy and Merkel. We've all become very familiar with all of the European leaders, and we at the investment staff, we've started to look at what's the election cycle for these people, because that is going to come up, just like with Greece having the confirmation or vote of a confidence vote in Papadreou. We're going to see increased political tensions. Here's the one that I think is very interesting. This is the interest rate for the 10-year bond, the government bond in those respective countries. So Germany about 1.8, very similar to us. But France is already up to 3%. But look at Spain at 5.5. Italy is the one today that everybody was worried about. Italy hit 6.5 today. Doesn't seem like a high interest rate, but when you think about the fact that the rest of the world is around 1.5 to 2%, that's high. And then you can look at Greece. Greek debt, 10-year Greek debt's trading at 25%. So we could make our funding ratio for 3 years if we were willing to buy that, put the whole fund in it, and we got paid. Right now they're talking about Greek debt holders getting 50 euro, on the dollar, or on the euro, half a euro on the euro. So they would drop their yield to around 12%, but it's trading up at 25 because nobody's sure if they'll even get that. The concern is that they'll get paid in drachmas and currency will get frozen. That's why the worry is about Italy, and that's the yield that we're watching now and concerned about. And then the next is the yield in Spain. And I would tell you that if you listen to Bloomberg in the morning, they're talking about those yields on the 10-year bonds. They're looking at the yields on those 10-year bonds on the New York Stock Exchange minute by minute. We used to not care what debt in Italy traded at every minute. It just shows you right now how the U.S., while it's slow growth and we care about the super committee, all the focus is on Europe. This was the cover of the Economist 2 weeks ago, and I thought it was just very appropriate, which was the European Rescue Plan, and it shows them in a colander with all the holes in it. What we're going to have to do is continue to watch that. When there was the view that a bailout or rescue package was in play, the market went up 300 points that day. Then when there's fear that it's got to go to a vote, the market drops 200. Then yesterday it doesn't need to be voted on, it goes up. Today it's up another 200. The volatility is extreme, and it is all focused mostly on what happens in Europe. What's amazing is even though the trading day starts at 5 o'clock here, it'll start trading in Asia. Their trading will be based on what happened in Europe this morning.
Chris finish his report, and then we'll take questions from the committee members. Okay?
To give you an idea of the European markets, this is Germany, the German equity market. It is down 20%. I should have said June, not June 20, since June 30. Sorry about that. But you can see it was down almost 25, almost 30%. It's actually rallied back up as in October with the markets overall. But it started its decline not based, it looks very similar to its decline being to the U.S. The U.S. was based on our U.S. debt downgrade. This was based on the realization of how much trouble Greece was in. And I should have pointed out one other thing in this prior slide. Both Italy and a little bit Spain, but mostly Italy, has a lot of debt maturing next year, which means they have to roll all of their bonds and come into the market in a big way next year. And that's why you've got to solve Greece now before it gets to Italy being a problem. This is the other stress that's going on in the background. Obviously, Occupy Wall Street and Occupy everything. This was also a cover from The Economist magazine a few weeks ago. Just so you know and you're aware, CTA has voted to support Occupy Wall Street. I know I've talked with Jennifer Baker and the staff. This is a picture of your CIO in Occupy Wall Street. I actually was in New York with Harry, and I went down there and walked through and talked to some people. You can't tell, but the sign on the orange tent behind me says, "My common sense is tingling." And I thought, my common sense always tingles. I don't have to be encamped in a park in New York. But it was interesting to chat with some people to understand their issues, and they are quite varied, and all of the efforts going on there. It is only fills a block. It is a lot of tarps, for sure. A lot of different issues, a lot of entrepreneurs, I would point out. People selling buttons, T-shirts. I was passed by 4 different people where their friend was walking backwards, videotaping them, talking about their protests so they could go and post it online. There was nobody else around them. And I was worried. I was in the backdrop a couple times, and I thought, oh, wait till the board sees that. There's Chris in the... But it was like, well, they don't want me in the backdrop. I have a collared shirt on. The street on this side is lined with satellite TV trucks, the entire street. So it's quite an interesting sight, but obviously they will stay there as long as they want. The stock exchange is very much surrounded with fences. You can only walk down, it looks like Disneyland. You walk down little corridors. So tensions, but the tension is there, and that's not good. It's not good for the U.S. It's not good for the markets. We talk about the wall of worry all the time, kind of up in the crow's nest. I'm not going to go through these bullet by bullet because we've talked about them before. But one of the newer ones that really has popped up has been this election idea. I guess it has always happened. It doesn't seem like we start having the presidential election in the early fall the year before, but now we are. The other is we had a very interesting discussion with a couple of managers on the China real estate bubble. Some certainly think that's manageable because of the general party structure, but they clearly have built cities with no occupants. They think they need them in anticipation, but we'll have to see how that all plays out. Certainly the Chinese banks are in a very difficult financial situation. They don't need to borrow money, so they're okay, but we don't have transparency, and no one has there's not a lot of interconnectedness with their banks. But clearly China, Brazil are the only signs of GDP growth, so we care about their economy and we care about how they're doing. We don't have exposure to the China real estate situation, and we have very little exposure actually to China. Only about 1.5% of the fund is invested in Chinese companies or companies related to that. We have a greater exposure to people like GE and IBM that do business in China than we do direct in China. But these are the things that we're continuing to watch and track very, very closely. Here's the S&P 500. I've been sending this chart to you periodically. And these are Bloomberg charts, so if you don't like the black background and all that, let me know and we can drop the data out and put it in a different format. But this is the S&P 500 since June 30. It is down 7%. Remember, Germany's down over 20. You can see we stayed in that trading range I kept highlighting for you through September, but then we broke out of it and the downside, and then we had the strong October. We're still bouncing around that range that as I printed the chart a couple of days ago, far from the highs of June 30, but also well off the lows. So our underweight to equity helps us when the market is negative, but it hurts us when the market rallies. So we are watching that very closely. So the strategy, what are we doing at the actual portfolio level? And that's really at the asset allocation. We're continuing to be underweight global equities. As we've told you, our interim target is now 49%. We're not trying to stick to that so religiously that we buy and sell the minute we move off of it, but we do talk about that a lot. The other area to be aware of is because the portfolio is down a little bit since June 30, it causes us to be overweight the private markets. So we're actually at over target 15% in private equity and about 13% in real estate. Because those are such long-term investments, we make an allocation today. It doesn't get drawn down. It gets drawn down equally over 4 years. So increasing that or decreasing that today doesn't have an impact on where it is on the asset allocation. And we continue to talk about PCA, about are there better ways to show that and manage it, realizing those are almost stuck in cement and those allocations, those portfolios don't change much in value where the other ones move around a lot. The cash position there is about 1.3% as of lately, and we'll talk later about whether we change the range on that. So questions? Oh, I have a question for you, actually. Sorry. I forgot. I added a pop quiz of what we can invest in. So I'm eliminating gold and palladium and diamonds and old masters paintings. Forget those. Of what we can invest in. What do you think is the best performing asset so far in calendar 2001? 11. Did I say that? 2001. Or subset, the stuff we invest in. What do you think is the best thing we've invested in? Big thing. I'm not getting down to finite stocks, not Apple, but stocks, bonds, type of bonds. Real estate. U.S. government debt. Uncle Sam, 22.7% so far this year. The one thing that got downgraded would have been the right thing. So you could have gotten a newspaper ahead of time, found out, oh, the U.S. is going to get downgraded. I'll buy some of that. And I think it's interesting. I grabbed this quote that appeared yesterday from Bill Gross because he eliminated treasuries. You know, the total return fund at PIMCO is the biggest bond fund in the world. He eliminated treasuries in February, and he went further. He actually bought derivatives and bet against them. So he was short treasuries starting in March. And you always challenge us to do a veritas or a look back and what went wrong. He quoted his a stinker, so that will be our new term of when it's bad, it's a stinker. Obviously, that was a little more than a stinker, because it's best performing area, and he wasn't, not just didn't own it, he was short it. So it's a challenging year. Oh, he deserved it. Terry, we're on video. He could be watching.
Beth?
Chris, I read stuff on Greece, and I get just kind of lost because the European structure is so different than what we're dealing with, the Eurozone and the various debts and all these treaties, and, it's just, it's not like our federal system. Everybody's a looser affiliation. But is the fundamental worry that the banks will default? I mean, that you will wreck the structure of European banks? Or is the fundamental worry that, I don't know how to say this, is suddenly there's a drachma instead of a euro that they drop out? And does that have some cascade effect on the other sovereign debt? What is the real core? I mean, I get it, if they default, it's bad, but what mechanically are we looking at, and then how does that influence our thinking about it?
You'll love this answer. The answer is yes.
Yes, okay.
Thanks.
At first, the reaction that Greece would drop out of the euro is, oh my gosh, the euro's going to collapse and the market drops like a rock. Then they think about it and they're like, okay, well, this has happened before. Countries have had to leave, and what they've done is paid, well, not euro, but I'm trying to think, there was a prior example of a default in another country where what they said is, instead of getting paid back in dollars or some other currency, our bonds are now denominated in our currency, and you can't sell our currency for 6 months, so that they can't just cause a run on the currency as well. So there are structural ways, if Europe wanted to isolate Greece and move them out, quarantine them. The governance of that is not easy. You've got 17 nations trying to all vote together on what's the right thing to do. Greece doesn't want to leave the euro, and I think their view is they don't want to break the euro up at all. They want to try and find a way to work this out, which would be paying bondholders 50 cents on the dollar for Greek debt. You're right. The people that get hurt are the banks that own that debt. And that's why you're seeing banks constantly come out and being very open about how much debt they own in each of these different countries. It primarily hits, and that's why Germany and France are taking such a lead role. It affects them dramatically, but they're also the two that have benefited from the euro and are the largest countries in the euro. Their concern is okay, banks have already written down that debt. Some have written it down to 80%, some even 75%. Very few have written it all the way down to 50%. They passed the stress test at that level. Now keep in mind the stress test has got flaws because we've already had one Italian bank go bankrupt because it relied on overnight money, and that wasn't included in the stress test. So kind of like if you borrow money, that's okay, but you got to pay attention to, are you borrowing it day to day or do you have long-term money? What they're worried about is the situation carrying over into Italy or Spain, where then you have the Spanish banks. Not only as countries and economies are they so much bigger and more important than Greece, but there's an enormous cross-section of banks that own that debt and that then own each other's debt. So that's where you get into our situation of systemic exposure across. And what we've tried to do in the portfolio is not just look at first-hand exposure and second-hand, but third derivative, fourth derivative. Do we invest with people in the U.S. who invest with people in Europe who have invested in the European banks who own the debt? Because you want to worry about how far does that wave reach if it potentially got. So that's why all the time, all the attention, all the absolute focus on quarantining kind of Greece and isolating the problem to there. Remember, Ireland's not all that healthy. It's gone through its own austerity. Remember, there are the full pigs, the two I's and the G and the S. So that's why this is a slow motion problem that I think they have time to work out. They've shown that they have the will and the interest to work out. The one thing I guess I keep having in the back of my mind is all of our attention right now is on Europe. we're going to come back and start looking at the U.S. come around Thanksgiving, because that's when the super committee is supposed to come out with our deficit reduction ideas. And we borrow a ton of money. Now, we're a better credit. We pay it back. There's all those reasons we won't be like a Europe situation. But we're going to have our own austerity plans. Obviously, in California, we're talking about our own austerity plan. And we know as citizens, we're not going to like it either. I mean, we make fun of the Greeks for protesting the things they're going through, but pension cutbacks, moving out the ages, wage cuts, governments are going to have to deleverage. And so that's why we're concerned. We believe what the Fed and the ECB are telling us. The GDP will be low for 2 years. Because you've got to go through that process. But you still have that interconnectedness. Long-winded answer to that simple yes. It is all interconnected. And it goes from emotions of, we survived the crash, I'm elated, I made it, I'm not healthy, but I survived the crash, to, oh my gosh, I'm back in a crash again. And that's why you see these huge swings up and down in our equity market and the world's equity markets. And I would say it's not just us at STRS, but for investors that I talk to of all scale and size, you talk to anybody that's been in these markets 20 to 30 years, and not only these more complex, more interrelated, more global problems that we've ever dealt with, but it is more difficult to be able to discern what the market will do with a particular piece of news. So it's back to my comment on debt. You could probably have the benefit of the newspaper around Thanksgiving. And I'm not sure, in the old days, you would know exactly how to trade to make money from it. Nowadays, I'm not sure you'd know how to trade it to make money from that bit of news.
Well, go on, just taking that kind of, I guess, again, more of a structural question, but I have some understanding of how we took TARP money and pumped it into the banks and what the Federal Reserve's doing and whatnot. Do you end up with these banks sort of flooding them with euros so that they have capital? And then this goes back to this core issue of, yes, we have 1%, now bonds are less than 1% and kind of zero inflation, but after a point, if you keep flooding the system with money, don't you hit some point where you inflate your, I mean, you are quote, solving the debt problem, but, I mean, you've got to have inflation somewhere in this system. And how, I don't know, because this can go on forever, but kind of quickly, how do we look at the European
That's why the
situation?
About 2 weeks ago, remember that I sent you the phrase EFSF, and I joked you can't say that 3 times fast. I know I can't, but it's the European Financial Stability Facility. Thank you. The key was, how big was it going to be? How much was Germany going to put in? France? It finally got to $1 trillion, and that's the number people felt, okay, remember our TARP was, what, $750 billion? Now they're talking about $1 trillion, and they think it might be enough money to contain the problem. And people debate about that. That will be part of the challenge, but it helps the banks deleverage. It helps the banks get through, but it isn't enough to get the governments to deleverage. Just like the consumer, that's a more, you think about a company, they reduced workload. In 2009, companies laid people off. They modernized, they changed things, they got rid of their debt very quickly. We as consumers can't do that because we don't have anything to tap into. We don't have our homes anymore to tap into. We have no way to deleverage, and neither do governments without taxes. So,
just Chris, staying on the trillion for a minute, but our money went to the banks. Do the trillions that the Europeans create go to banks and then to sovereign debt reduction in member countries? Are they circulating this stuff? I mean, in other words, is the system going to stay afloat by flooding the world with euros?
It is going to try and support the sovereign debt and buy sovereign bonds so that they, when no one will buy Greek debt and it goes to 25% yield, they can step in and buy it and own it and help the banks out that way by buying it from the banks and getting it off their books. And that's what it's structured to do. There is no question that what we've done and what Europe has done, if we look at the economics playbook, it says that equals inflation. And that's why we want to build the inflation-sensitive portfolio. Originally, we talked about commodities. I was worried we didn't have enough time Now we have more time. We're talking about 2 years
Why are we
before.
deflated now when we're, I mean, what is the deflation that we, I mean, our quote Japanese problem, when we're busily creating trillions and trillions and trillions of dollars and euros and pumping it into the system? Why do we stay deflated? Why aren't we inflating?
It would be a and I'm not an economist. It would be a longer-term issue, but it's the fact that inflation is primed to be there, but it is not there because there's not the purchasing power and the GDP growth. But that's going to be the question is wage inflation is peaking up in little places. Every once in a while, I send you a report that shows wage inflation popped up again. And inflation pops in many different ways, but we had commodity inflation, and then that went away. Now copper is way, way down in price. They call it, you'll see me send you stuff on copper because it's a good predictor of manufacturing demand. But we had wage inflation for a little bit, then that ebbed and flowed. But at some point, as governments stabilize, we're going to see that climb back in prices.
What we're doing is navigating this inflation deflation as best because.
What we're trying to do with the portfolio is navigate this economic uncertainty. We know we're not, anemic is the key word. We're walking, the economy is moving, it's growing at 1, maybe 2 to 2.5%. So we can't ignore that. We want to own equity exposure. But we also know that one slight kick and the U.S. economy would just slip right into a recession. I mean, think back just 3 weeks ago. That's all the talk of, we're in a recession, must be in a recession. Well, now we've had a couple of weeks of decent statistics. We're not in a recession at all. In fact, they're looking at third quarter GDP to be 2.5%. So we're trying to navigate that with a portfolio of be defensive, but not just sell out and hide, because we know the risk is the markets actually could rally, not as much as they did last year, up 30%, but they could rally from this point and easily post a 10 to 15% gain, and we don't want to miss that. We need to make 8% this year, and basically now we have 9 months, and we need to make 11% because we're already down 3.
Any other questions from the committee for Chris? I think the last line of questioning is a good example of where we don't want to put our chief investment officer in the position of trying to be an economist for us. And at the offsite, we talked about perhaps having an economist come and speak with us periodically about forecasts. So we can follow up with Jack and Chris and talk about maybe where we could fit that in. Chris, thanks for your presentation. I think you did a nice job, and over the last period, we've been talking a lot about risk and volatility and uncertainty, and your slides again reinforced that that's a period that we're living in. And I think our next 2 items do a good job of transitioning us right into some policy issues that we're exploring. So I'd ask Stephen Tong and John Linder. I think you're going to present next on item number 8, which is the risk-based assessment investment strategies, part 2.